Okay, well, it looks like it's 11 o'clock here on the East Coast, and I guess that what makes it 8 o'clock there on the West Coast. Hello, everyone. Great to see you. I wish I could see you, but I guess this is the next best thing. Hopefully, soon we're going to be able to have our live lunch and learns downstairs. Hopefully in September, we're going to work on that. We will see how that goes. We'll take a look here now at our formalities, just some disclosures, disclaimers, and whatnot, Magellan Planning Group. So today we're just going to talk about, this is what we call our halftime report. And essentially, we're just basically looking at the first half of what happened for 2021. We're still overcoming this pandemic, and there's vaccines. Now there's different variants, and hopefully the vaccines will, I'm reading that the vaccines seem to be holding up against the variants, so that's good news. And then we're going to talk about what happened in the markets, and then we'll talk about some forces that we think are going to happen in the next part of the year. So let's just take a look at the S&P real quick here. You can see that obviously last year Biden was inaugurated in January, and then there was a lot of hubbub after that, if you want to call it that. So the market took kind of a hit there. And then, the whole thing really was about getting back to work, getting the economy going again. And the vaccines, I think, really had a lot to do with that. So, COVID-19 relief bill, that was about a $2 trillion bill in March 11th. So really, the name of the game for the first part of this year, at least, has been stimulus and vaccinations, and that's really been the majority of it. So it looks like unemployment has gotten a little bit better, and that's good as more people are going back to work. So if you just take a look at the S&P 500 over the last 10 years, we have gone from 1,200 to now 4,400. So that's right about where we are today. There was some volatility earlier this week, and I think a lot of that is either coming because of the new variants of COVID, but it also is because of some inflation signs that we're seeing. And I'll explain to you here in a little while why that's important. But, we have to ask ourselves, we've almost quadrupled here in about 10 years. I mean, is that something that's really sustainable? And we're concerned. I'll be honest with you, I'm concerned personally. And we've done a lot over the last year to do what we can to mitigate any type of risk that's coming down the pike. While we also don't want to get out of the market. I mean, that's not a great solution either, because we just don't know how much longer or how much stronger this bull run could go. If we take a look at corporate earnings, these are one of the huge things that we look at. Those have been really strong. Obviously, they took a dip back when we had the lockdown. It's hard to have earnings when your economy is in lockdown, right? But I mean, I was very surprised at how quickly this recovered, and the earnings have recovered. And now you hear about you can't get a tile installer, you can't get a carpet installer, you can't get a builder to call you back, because everybody's is just backed up by at least a year, it seems. So there's definitely been a lot of demand for home improvement. There's been a lot of demand for even housing now. I mean, there's bidding wars going on here in Atlanta that I know of. So it's very reminiscent of earlier times, and I'm gonna show you what I'm talking about. But corporate earnings are doing well. So the problem is that the price of the stock may not be justified by the earnings that we're currently seeing. And the question is, well, are those earnings going to become more in line with stock prices, or are stock prices going to become more in line with earnings, right? And or maybe some of both. And that's kind of the question. And of course, I always get the question of, well, when do you expect big changes to occur? And I'm going to go ahead and tell you right now, I have no timeline. I do not know. But if we look at our price earnings ratio, this is the last 90 years. And so this is the S&P 500, just price earnings ratio, the price of the stock vis-a-vis its earnings. So the way you kind of look at this is the earnings of a stock, how many years would it take these earnings to pay for itself? And the average over time is about 18. So over the last 90 years, it would on average take about 18 years for the earnings of a stock to pay for itself. Now you can see there's some big spikes in here. This first spike here is what happened in 2000, with the dot-com. And then the second spike here is in 2008 with the Great Recession. And then the third spike here is where we are today. So you can see that where we are today in terms of the price earnings ratio is actually even higher than it was back in 1999 and 2000 when we had the dot-com bust. The 2008 Great Recession, really, if you remember, was sort of started in the financial sector, because we had all these mortgages, remember, these subprime mortgages. They had been repackaged as default swaps, and then all of a sudden they became AAA, because I think the ratings companies didn't really understand them, so they gave them a AAA rating, and then a lot of people invested in those, and then interest rates started to rise. And then once interest rates started to rise, those mortgages that were, remember, they were 3-1 arms. So those 3-1 arms, those mortgages started to reset. And then as they started to reset, those payments would double, and then people would just start defaulting. And then so that we could see defaults coming, we could see resets coming, and then we could see mortgage defaults coming. And we actually had a 2-year sort of warning before it even happened, but no one was paying attention. And then that's what crashed the market. Like usually it's a credit lockup that crashes the market, because people have to sell, and then they start selling in a panic, and more people sell. So again, here's the word of the day: is that sustainable? I don't think so. I don't think so. So that's something that we always look at, and that to me is a warning sign. That's one of the things that we look at, and I'm sure that would make sense to most of you. So let's just take a look and see what drove the equity markets during the first half of this year. If we sort of flash back to 2011, in January 2011, remember we were coming out of that Great Recession, and 2008, that was a bad hit. It took us a while to sort of get back on track, and it was about 2011 really before we started seeing that growth again. And you can see a lot of these indicators here. You've seen these before, but we've got things like, equity market valuation, that looks good. Interest rates look good. Inflation was low. Monetary policy was very easy. Remember, we had 0 interest rates for a long time. We're way down there into the, lower than 1. Fiscal policy, we're always spending money here, so that's great. And what do you know? Political environment's negative. Well, that's usually the case. So now let's fast forward 10 years to 2021, look at the same sort of indicators, and not quite as green. We have a lot more yellow, a lot more caution on the line there. So political environment still negative. Geopolitical risk is always there, it seems. Monetary policy, the Fed's still very, very easy. We've been printing money like crazy. We've been buying bonds like crazy. We've been doing stimulus like crazy, and our interest rates are basically 0. The concern that I'm having is, in other places around the world, and in Europe, Switzerland, and Japan, and Germany, and some other countries, not now, but especially in the past, rates did go negative for a while. And my concern is that if we're already at 0 interest rates, and we really don't have a whole lot of room to raise rates, because you can see already the market is starting to teeter when people are just talking about it, because all we're doing now is talking about inflation. We haven't even started talking about raising rates yet, but everyone knows that's what's next, and so that's the fear. If we go ahead now a few more months to April, things are starting to look better. I think a lot of this has to do with the vaccines, and people are getting vaccinated, and the people are starting to go back to work. I can tell you that when I go out to eat now, it's completely crowded. I mean, there's waiting times. It's back to old Atlanta, the way it used to be. It's very strange for a couple of years there with this pandemic, going places and they're closed. Lots of businesses are completely closed. So we definitely want to support the ones that are left, because so a lot of my favorite restaurants are no longer with us. So I'm really sad about that. But again, here we are, April 2021, and all the dials look pretty green. Even geopolitical risk is yellow, and political environment is yellow. I guess it's less screaming or going around there. So that's good news. Again, a lot of the what we've been going through with this pandemic has obviously a lot to do with the market, has a lot to do with the economy. A lot of companies were really hit. You think about the airlines, and then a lot of companies really did well. So it definitely had its winners and its losers. And you know, we've had a lot of additional fiscal stimulus, which is a lot of money just being, you know, dumped out there to try to cover everything up. So that's a concern going down the road for me, at least, because, well, not all of us, because of the inflation concerns. But if we just take a look at the trends that we've had with COVID-19, you know, the cases are dropping. I just read this morning that, you know, the Delta variant is the one now that seems to be showing itself more, and there's more cases of the Delta variant. The good news is that the vaccines seem to be effective against the Delta variant for the most part, as far as what I read. You know, you never really know any of this stuff. But at least the cases are getting better. And if we look at, you know, all the vaccinations, the good news to me is at least that almost 90% of everyone over 65 has had at least one dose. So I think that's great news, because if you remember, the majority of the deaths that were occurring, especially early on, from my recollection, was at least, you know, they were mostly, you know, elderly people and older people and people that were somehow had their immune system compromised in some way. So obviously about half the population has been vaccinated, but I think it's great that that most of the people over 65 are vaccinated. Way to go. Good job. You got on that. So let's talk about, you know, some market forces. What do we see happening in the second half, or what potentially could we see? You know, I talked about inflation, and inflation is the big concern in the financial world right now. Why? Well, because when we have inflation, that's a sign that the Fed is going to have to try to curb inflation. Well, how do they do that? Well, they reduce their stimulus, and sometimes they raise rates. And generally, that will sometimes lead to a correction. Oftentimes, it does lead to a correction. A lot of you know that I follow the Austrian School of Economics, Ludwig von Mises, and those guys. And you know, they've gone into quite a good bit of detail, and I'm pretty convinced that that it's the monetary contraction and expansion that causes a lot of these market booms and busts. And so we're kind of at the top of the boom, and now it's time to have some contraction, because inflation is showing itself even on our third iteration of the formula. And I'll talk about I'll tell you what I mean here. So there's a guy named John Williams, and he put together a group called Shadow Stats, and basically they just track outdated statistics. So statistics that the government used to use but no longer uses for what reason or another. So back in the 1980s, we had the Bureau of Labor Statistics had a formula to calculate inflation that I thought seemed pretty honest, seemed pretty fair. And here you can see it. That's the blue line. So that's the 1980 based formula, the way we used to do it. And the current formula, which is now the third iteration, we changed it again in the 90s, is the red line. And you can see that it's considerably different. So, you know, if we're looking at the red line, which is what we're talking about now, there's been a big rise in inflation even on the third iteration of this formula. But if we go back to the original iteration of this formula, and we're closer to 12, maybe 13% inflation if you look at it, you know, across the board. I know certain things are cheaper, computers are cheaper, printers are cheaper, guns are cheaper, but you know, if you go to the grocery store, the things that we need every day, the things that we eat, you know, the things that we use, energy, those things are more expensive. And there's different reasons for it. Obviously, there's some good cases to be made for supply, and, you know, obviously the demand is there and the supply chain is not completely full again or active again, whatever it may be. But certainly it's also been because of our stimulus and our a lot of our monetary creation. Take a look real quick now on the labor market. Unemployment has obviously spiked in March of 2021, but now it has dropped considerably. And we're back down now to, I guess, March 2021, we're back now to 4.4%. Well, that's unemployment rate is 6.2%. That's the average. Okay, so our March 2021 is at 6%. But I got to tell you, again, this formula has been changed. If we go back again to shadow stats, they follow these formulas. And a lot of you may not know how this formula works, but if you look at the red line, what we have here are, that's the headline unemployment. So these people here are not discouraged workers. They're unemployed, but they're not discouraged. And they're short-term unemployed, not short-term discouraged, and not long-term discouraged. What happens is, once you become discouraged, and I really have not been able to find the definition of that. I assume you're no longer looking for a job, whatever it may be. But if you're no longer discouraged, then you come off the red line, or if you are discouraged, you come off the red line and you go on to the gray line. But if you're long-term discouraged, in other words, you've been discouraged for more than a year, you've been unemployed for more than a year, and you've been discouraged, okay, then you come off the gray line and then you're on the blue line. So the blue line is the shadow stats line, which just tracks people who are unemployed, people who are looking for a job, want a job, but don't have a job. These other lines, these other numbers, again, are, I think, misleading, and they may be intentionally misleading, but obviously it looks a lot better, right, to say, oh, well, you know, we're under 5%, when the reality was we never were under 20%. That's, I'm just pointing it out. Consumer sentiment, this comes out, you know, about every other year, or well, about every quarter, really, about from the University of Michigan. They're, you know, they have about 500 people that they call around the country, and then they ask them different questions. How do you feel? And, you know, but the thing about consumer sentiment is it's always sort of in the past. I mean, it's not a forward-looking projection for me, because can people feel based on how their 401ks look? I mean, if their 401ks are looking great like they are now, probably better than ever, they feel great. I mean, and when we had the drop in 2019, that was a pretty sharp drop. It was a 30% drop off the Dow. So they were probably feeling not so great, you know, and that's and luckily it did come back. So if they didn't sell out, then they didn't panic sell, then they recovered and they did well after that. Because you remember, we were pretty much right back where we were just within 2 or 3 months, and then since then it's just been kind of gangbusters. So consumer sentiment, that's what it's there for. Residential real estate, I think you've all, I don't know if you know anyone who's sold their homes, or you've seen your neighborhood where people are selling their homes, or maybe you even looked your own home up on Zillow, but home prices are through the roof, and I think they're an all-time high, and we've seen this before. We've seen this before, and it's just, you know, again, it's one of those things I have to ask. I mean, is this sustainable? I have friends that are in the real estate business, and just like our business, it's cyclical, you know, and when the markets are down, nobody feels like buying a home. Right now, everybody feels flush with cash, and they want to upgrade, and they want to move, and who can blame them, right? But it is cyclical, and so that's something that we're obviously watching. And right now we're gangbusters in terms of our home prices and sales. One thing that was surprising, I think, and not really, because if you look at inflation and you look at the increase in the value of people's homes, then basically the average consumer has increased their net worth. This was, I think, a good lesson that I think a lot of people probably learned back in 2008, because people were in a lot of debt then. And since then, I've noticed consumers, at least, have really, really worked to shed their debt. And I think that's fantastic. And so we've seen that the average consumer's wealth has increased, but you got to remember, you got inflation. So that's, you know, houses back in the 1950s were, you know, less than $100,000. Now you can't find one for less than 800,000 in this area. So, you know, liabilities have stayed pretty standard, which is pretty good, pretty straight. I mean, against all the efforts of all the credit card companies and all the banks and all the car financing groups that are trying to get you to finance for 0% interest for 70 months, right? That's kind of a new thing for us. So if we look, and, you know, if we just kind of think about what could potentially happen, you know, this pandemic has been a black swan event. So, you know, you never really can predict a black swan event. You just have to know that they are floating around out there. It's like black holes, and sometimes they can just show up. But, you know, one of the things that we're obviously looking at right now is inflation. And then you hear about bond yields trending higher rates in the bond yields. I'm going to go over that in just a second. And then maybe corporate earnings disappoint. Maybe some companies do really, really well, as we've seen, and maybe the broad market is not feeling so great. I think the airlines were down a good bit yesterday just because of this new Delta variant. I mean, and what's that going to be? So, you know, the market hates uncertainty, and certainly we have had our share of uncertainty. I mean, we've had this pandemic, and now we're on, I don't know, epsilon, alpha, beta, gamma, delta, epsilon, zeta, eta, theta. Well, who knows where we'll end up? I hope not omega. So, you know, looking forward, this is projections for the GDP. Actual GDP has trended down here, you know, just because of the economy has closed down, but it's now trending back up again. So projections for 2022 and 2023 are you know, good. You know, it's interesting because you never have negative projections. They're always positive projections. So, but these are the projections of what we're looking at. We're getting this from, again, the Federal Reserve. Inflation expectations for the Federal Reserve. You know, you hear a lot of people talk about transitory inflation and the supply chain, you know, inflation, stuff like that. I'm sure there's some of that, yes. But if you look at all the money that we have added to the system, that was just newly created money, that money gets out into the system and it competes with your dollars for the same resources. We don't double our resources on the planet just because we've doubled our money supply. In fact, when we double our money supply, we basically cut the value of our currency in half, because you can't create something out of nothing. It's just always factual. I can't change that. We can't change the laws of physics. It just doesn't work. So, you know, inflation, yes, creeping up. You saw the shadow stats inflation rate. It's over 10%, could be 12, could be 13%. I hope that trends lower, but I don't think so. I think inflation's here to stay, and I think it's going to pick up. If we look at the total assets of treasuries that the Fed has bought. So here's how it works. It's somewhat convoluted because you have the Treasury Department and then you have the Federal Reserve. And the Treasury makes up these things called treasuries, right? And they just make them up. It's just a bond, just a piece of paper that says, hey, we owe you this. And it's not even a piece of paper anymore. It's all electronic. So you have the Treasury, and they have these things called treasuries. And then you have the Federal Reserve. And then the Federal Reserve buys those treasuries. Well, they call that building their assets, buying treasuries, whatever you want to call it. They call it anything but printing money because that's a negative term. But essentially that's what's happening. They're creating new money out of nothing, computer strokes, to buy these treasuries that are out of nothing, and then they swap. And so now the Fed has these treasuries, they call those assets, right? And then the Treasury has this cash, which was just created by the Fed, and then now the Treasury spends that, and that's where your Social Security checks come from, and Medicare and Medicaid and all those government programs, and cruise missiles and submarines and all those cool things. So that's how it works. And if you look here, since 2008, 2009, the assets of the Fed have increased considerably. We were at about $1 trillion in 2008, 2009, and now it's over $8 trillion. So those are assets that are held by the Fed, that they bought from the Treasury, that they bought with money that was made up, and the Treasury made up those bonds. And so our debt, which is about a little over $20 trillion now, roughly a third of it, if not more, is owned by the Fed. And the best of it all, we're paying them interest on that. So, I mean, it's it goes deep, but that's why we're having inflation. That's the real reason we're having inflation, and that's why we're gonna have more inflation, and that's why inflation is here to stay. So I'm just pointing it out. Federal Reserve meetings, these are when the guys get together and determine what to do next. Are we going to raise rates? What are we going to do? And they're really between a rock and a hard place because interest rates are down, well, at the bottom, and we have inflation, right? But we can't raise rates because if we do, it's going to crash the market. So what do? Well, we've already tried to lie our way out of it by telling people that there is no inflation, but that's not working. So what are we going to do now? Well, this is the Fed funds rate. This is when they get together and figure out what they're going to do. Are they going to raise rates? Are they going to keep them? What are we doing next? And you know, if you take a look at this, you can see that right, and not in every case, but usually right after these rates rise, you'll see a gray line. You know, so we have rates go up and then they turn around. Rates go up and then they turn around. Rates go up and then they turn around. Well, why are they going back down so quickly? Well, the reason they're going down so quickly is because the market crashed. They were raising rates, and they kept raising them, and then the market crashed, and then they had to bail the market out, and that's why you have these peaks. Otherwise, you wouldn't have. Why would you have a run up in interest rates and then immediately turn it around? Well, you just didn't know what you were doing. You were raising rates and you just didn't know when to stop. And then the market told you when to stop. And then that's what these gray lines are running vertically. Those are market recessions. And yes, there was one in 1987 too. But you know, you have to go 20 months before it shows up as a gray line. So there's all these little rules that they have. But here we are, 2021, we go over here sitting with 0% interest rates, and we've got inflation. Even our third generation of formula is showing inflation has picked up 4 or 5% annualized. So it's a tough spot. I don't know what they're going to do, but I guarantee you they're having the conversation about negative interest rates. Is that possible in the future? I mean, I know they're having that conversation. You know, may you live in interesting times. That's all I can say. Real quick though, on the bond prices, there's a lot of misinformation about this in the media, just with everything else, I guess, too. So bond yields are not rising. Okay, if you issue a bond has a coupon. Remember those coupon bonds that grandma used to have, and she'd cut the coupon out and mail it in, and they send her some money, or she'd go down to the bank and deposit. Those are coupon bonds, but you don't have those a lot anymore. But what you have is a coupon payment, an interest rate payment. So if I have a bond and my bond is worth $1,000, and at $1,000 it pays 5%, okay, we'll call that par. It's a par coupon at 5%, the par value of 1,000. Okay, if there's demand for that bond after it's been issued, then the price of the bond can go up from 1,000 to say 1,100. Well, it's still paying a par value bond coupon of 5%. But if the value of the bond goes up, a new buyer to that bond has to pay more than $1,000. They have to pay more than par. They have to pay a premium. So from their perspective, the interest that it's paying is less than 5%. Does that make sense? The opposite can happen. So if bond values drop, the bond is still paying the same interest rate. Interest rates aren't rising. What's happening is the bond prices are falling. Well, why do bond prices fall and go up? And why do they go up and down? Supply and demand. Okay, we have X amount of bonds, we have supply. Greed on is I don't want bonds. Greed off, fear on is I do want bonds. So that's what's happening. When the market is going boom gangbusters like this, people sell their bonds, buy their stocks. When they sell their bonds, the bond price drops because we have the supply, but now we have less demand. Bond price drops, so therefore the yield will rise. Okay, it's not like it's rising in and of itself. What's happening are the bond prices are changing. So the next time you hear somebody on CNBC tell you that bond yields are rising, then you can explain it to them. I hope that helps. If you have any questions, I'm always here. So I'm looking forward to talking to you. So last but not least, all right, I want to play a little game. I want you to take a look at this chart. There's no dates, there's no numbers, but it is the NASDAQ, I'll tell you that. And I want to tell you this is where my main concerns are coming from, other than the fundamental things that we look at. There's also technical analysis. I'm not a big fan of technical analysis, but when it communicates and coordinates and says exactly the same thing that my fundamental analysis is, I have to look at it. So here's the NASDAQ. And I want you to sort of guess, and if you were in a classroom, I'd ask you these questions, Ted. You probably have already guessed it, Ted. But what year are we looking at here? You know, take a look at this. You may remember this. That was the dot-com boom, right? Well, we all have the benefit of history and hindsight now to know that that was not sustainable, right? So if we go back and we look at the year 2000, and I want you to focus on the year 2000. If we're sitting there now looking at that and we don't know what the future holds, we have to ask ourselves, and I asked myself this in 1999, is this sustainable? You know, because I'm looking at these price earnings ratios. You had the NASDAQ going crazy because of the internet. It was a whole brand new thing. Okay, but focus now on that year 2000, and now look what happens next. Okay, we know that after 2000, the dot-com bust, boom, and then bust. There it is. Okay, well, sure looks very, very similar, does it not? It just looks a whole lot larger. And we know what happens. The bigger they come, the harder they fall, right? So I'm not saying it's imminent. I'm not saying it's going to happen. You're intelligent enough to know yourself what you think. You know, I think what I think. But if nothing else, it's a time to be concerned. It's a time to be concerned, and it's a time to be careful. And if you play your cards right, it's also could be a great time for some opportunities, because if we go back and we look at what happened back then, look at that massive drop, you know. So it went up to about 4,200, 4,400, 4,300, and then dropped all the way back down, you know, to 1,900, 1,800, and it's just been gangbusters kind of since then. So I think if I really had to guess, if I had to bet my life on it, I would say that we're in for a big one. We're in for a big one here in the NASDAQ. And just like in 2000, it's going to drop, you know, all equities are going to be guilty by association of being equities, you know, and we've seen the volatility already start. We've seen this market start to peter out. And I know they continue to pump the stimulus. I know they continue to pump the free money, and they continue to buy the bonds, and they continue to flood the market with, you know, freshly created cash. But there is an end point. It just can't go on forever. And again, the name of the game, the word of the day, is this sustainable? And I don't think so. And for most of my clients who are retirees, you can't take that risk. But remember, I've talked to you, for some of you, it's a great opportunity to buy in, because if we've got cash sitting in treasuries and this market drops like this, great buying opportunity, because the world's not going to end. Okay, the market's not going to go to zero. We're going to see this again and again and again. We'll have another correction. We'll buy in. We'll have another big run up. It'll happen again. So we'll be doing this until I'm 70, 80 years old. And I hope you're still with me. Okay, so that's my story today, and that's what I'm sticking to, is that our concern is the NASDAQ is overvalued, it's overpriced, and we're looking for a major correction there, and that's going to correct the rest of the markets. And then next thing you know, those floor installers and carpet installers will have some time to call you back, because their business will eventually slow down, just like it always does.